Market commentary for the 26th of August 2019. Welcome to a new week and the last one for August. For those in the UK, hopefully everybody enjoyed an unseasonably warm bank holiday. Don't let anyone tell you where they can't get hot in London during the summer, because it can. And they don't have air conditioning, so yeah, special. Anyway, I can get away with saying that because I'm a Brit. So last week ended with a bang. President Trump's various tweets sending stocks and the dollar falling at a rapid rate of knots. G7 meeting over the weekend. We're looking for some surprises there, maybe some mutual love between China and the US to begin the week. Who knows what will happen from here? As it happens, the FX markets in Asia opened very nervously and almost immediately saw a very sharp move lower in the traditional risk-off trades. Dollar yen dropped from 105.40 down to 104.45. Aussie US dropped from 67.40 down to 66.90, and we saw gold leap as high as 15.55 from a close around 15.25 in New York on Friday. Asian equities all followed on from Wall Street's move lower. The Nikkei ultimately closing lower by over 2%. However, without any further real negative headlines and nothing too much coming out of the G7, the FX market began to undo much of the earlier moves, with dollar moving back up to 105.20 and Aussie back up to 67.40. Pretty clear the market had got caught short in early Asia at some poor levels, and the slow grind higher continued into the European session. Then out of nowhere we get what I refer to as a Trump tweet from G7, essentially claiming that China has indicated that they want to return to the negotiation table, and the US is happy to do so also. Immediately we get some movement in the markets. We get the squeeze on with US equity futures surging higher. The Dow Jones futures at one point up over 200 points. We have euro dollar dropped down to 1.1107 from around 111.40, and we now have dollar yen all the way up to a high of 106.40, 200 points off its lows earlier in Asia. And Aussie pushes up to 67.70, which is a good percent higher from the earlier lows as well. And gold pretty much falls back to where it was at New York close on Friday, around 15.25. Towards actually a denial from the Chinese. They had never made such a claim. But aside from a brief dip in dollar yen, the markets seem to have been keen to focus on the potentially positive news. I guess it's a case of who do we believe most for today. It appears that the markets are keen to back Mr. Trump and assume there will be some return to the negotiating table. Crypto has remained stable to start out the week. Bitcoin had a one brief pop up to 10,700, but slips back to spend most of the day near 10,300. ETH followed a similar path, squeezing up to 194 before slipping back towards 189 for the majority of the US afternoon. So once again, too much else going on in traditional markets for the digital asset world to really get a whole lot of focus. As the day progresses, stocks just continue to edge slowly higher, with the Dow Jones eventually closing up 269 points, and the S&P and NASDAQ both closing up by over 1%. Euro dollar ends the day at its lows around 111, and we have dollar yen closing at 106.10. Gold just off its lows at 15.27. Just when we thought the world was ending on Friday, all it takes is one tweet from the tweeter himself, and apparently the world is not ending, or at least not for Monday. For a technical piece today, I wanted to get you to take a quick look at the dollar CNH exchange rate, which is also referred to as the offshore Chinese yuan. And this isn't really showing any great trade idea or otherwise. It's really just showing a little bit of historical perspective around this particular exchange rate. The onshore exchange rate and the offshore exchange rate do differ a little, but not by a huge amount. And you've probably heard a lot of reference over the past couple of weeks about the US dollar yuan rate fixing above the 7 area. And I just want to show you why that's important. So if you look at this particular chart here, you have in front of us, it's it goes back to 2010, 2011, depending on where you're putting your data from. As you'll see here, the low, this is a daily chart, the low over all that time was about 601. And if you looked up until probably about 2 weeks ago, the high would have been around 698.70, maybe somewhere around there. So you can see it's sort of stuck in that sort of 6-7 area. Now, the US has made various comments about Chinese exchange rate policy. They've somewhat tried to refrain from calling them a manipulator. But the fact of the matter is the Chinese do manage their exchange rate, and for the most part, they're fairly happy to keep it within a band. They don't announce what that band is, but I think it's fairly safe to say that somewhere in the 6-7 region probably makes sense. What they've done in the last couple of weeks is they've deliberately allowed their own currency to weaken, and for this exchange rate to move up through 7, up to a high of around 718.30. What effect does that have? Well, the weakening of their own currency makes their exports more attractive. What they're trying to do really is negate the effect of the US tariffs, which obviously is driving the US administration nuts. That's why you've heard various comments from them about coming in and intervening and trying to weaken the dollar, etc. That's what all this conversation is around, because this is one tool which the Chinese kind of have, which the US don't really have. The Chinese will fairly openly manage their currency and manage the levels of that currency, whereas the US, along with the majority of the G10 nations, are committed to allowing their currencies to freely float, even if they do jawbone once in a while about being too strong or too weak. So that really just sort of paints a picture. I would think if you did see an agreement between the US and China tomorrow or next week or whenever it may come, it will be natural to expect this exchange rate probably to fall back to the low 7 level and be sort of managed back within this area. The US may want something in a trade agreement that gets the Chinese to commit to freely allowing their currency to float. I wouldn't imagine the Chinese are going to jump at that one anytime soon. But worth keeping an eye on. Keep an eye on these levels, because this is very important. And the higher this moves, the more pain it ends up costing the US. So it's worth keeping an eye on. It may not be something you trade. It may not be something you ever want to trade, but it is worth keeping an eye on, because I think it has far-reaching consequences for other markets, especially the US equity markets. So just a little bit of historical perspective there. And with that, I shall end the history lesson and bid you all a good night or good morning wherever you are, and look forward to speaking to you tomorrow.